are you from?
I'm from Dallas.
Dallas.
Yeah.
You are from Dallas.
Yeah, I'm from Dallas. Yeah. So I'm
you're from Jersey.
Dallas boy.
I grew up in Brooklyn, and then right before high school, moved to Jersey.
Where in Brooklyn did you live?
Brighton Beach.
Oh, yeah.
And this isn't, you're not interviewing
No, I
us,
know.
okay?
I'm just
kidding.
Nice try.
You're originally
from South Florida, Fort Lauderdale area.
Fort Lauderdale.
Yep. And then went to school in Boston, stayed in Boston for a bit, working in real estate, and then moved to New York for the job at Brookfield.
So what were you doing before Brookfield?
So I worked at a small real estate fund manager called the New Boston Fund,
Okay.
which was effectively a family office turned themselves into a small cap fund manager, sort of New England, mid-Atlantic focused, apartment, what we used to call flex, we now call life science, maybe it's office again, I don't know, industrial, sort of small cap investor, good value
Flex
add.
became co-working.
It was flex, think of flex like a pseudo warehouse that had some office that was probably over the last 10 years converted to life
So that's
sciences.
like
that is now
small
probably
bay or
vacant
some
life
small
sciences,
bay.
maybe office again.
Jeez, taking shots at life science. Ben Brown, great to have you, man. It's really cool to meet you. You are very storied. In New York.
Storied.
Yeah, I know
You actually are. You actually are. We told some people that were having you on. They were like, "Oh, wow."
Yeah.
Did you get stories? Or just storied in the context
We'll
of...
see. I think you're storied. I think you're a humble guy.
Okay.
So I'm going to say some words, and you're just going to have to take them. All right.
Fine,
So
Brookfield is one of the largest alternative asset managers really in the world.
Yeah.
And you are head of real estate or co-head of real estate for the Americas. So this is very cool to have you on right now.
yeah, and you spent the majority of your career there now, I think, right?
Yeah.
All right, tell us how you started there and how you got to where you are today, and then we'll ask the dirty questions.
So good story on how and when I started, and then a lot of the other stuff is probably less interesting, so I'll fly through it, and then we can talk about what I do today.
Great.
But I think as I was just telling you before, as we were getting started, I was working for a small fund in Boston. And this was pre-global financial crisis. So went to undergrad in Boston, and part of my time there, I was doing sort of internships, but I was in a program where you'd go curriculum half the year and then full-time work half the year.
Right.
And so what I did was a lot of my full-time work over the three, sort of call it a year and a half, the 3 6-month blocks was in real estate. So it started... Joe Sitt gave me my first opportunity in real estate in Manhattan.
Okay.
Again, pre-GFC. I was like, wow, this is amazing. Look what these guys are doing. You're in New York. And then I went back to school for 2 semesters, and then decided, I still want to get more experience in real estate, but I got to learn all facets. So I went and worked on the commercial banking side, which was Sovereign Bank, which is Santander now. Yep. Sovereign Bank in Boston. And was working on the lending side. So got to understand how deals are capitalized, underwritten, et cetera, from a banking perspective. And at the time, one of our banking clients was this small Boston-based fund manager called the New Boston Fund. And they had an internship program, which was for MBA students. And I was an undergrad. And I had sort of cold called them. I had asked my boss at the time, hey, can I reach out to them? I want to make some connections, natural networking. And I sort of cold called them, introduced myself, said, hey, I'm an undergrad at Northeastern, going into my senior year. I'd love to be part of your internship program. I know you only take MBAs. Can I just come meet you, have a coffee? And effectively did that. They let me into the program. I interned with them that summer, which was great. It was just another different experience that I had, and was fortunate enough at the time. They were growing. They had just raised a new fund, and I effectively just worked there through my senior year and rolled into a full-time job. So I never really had the full experience of like a proper job search. And it's also what at the time probably kept me in Boston as opposed to moving traditionally to New York or San Francisco or another market.
But that's real hustle because you cold called essentially. Rather than doing the traditional MBA.
Isn't it funny you can't really do that today?
You know what? I will tell you, it happens to me all the time. Young kids, so some way, shape, or form. Now, part of it is having a name like Ben Brown. It's probably not hard to figure out your domain at brookfield.com. But every now and then,
ideas here.
Every now and then, I still do get that, and I try my best. Now, I'm not saying this so I get 1,000 emails tomorrow, but I try my best to at least
please don't email Ben, please.
Try my best to be responsive, because I just remember literally sitting in that seat, passing out
100%.
emails, looking for someone to just say.
We do the same.
I'll tell you a
Yeah.
funny sidebar. I had that same itch, like coming out of college. I really wanted an internship, and at the time, my dream was like to be a music producer and be. I wanted to
has
be in
that
a record
changed?
label.
Is that not? The
No,
case anymore?
it still is.
not too
I'm
late.
gonna do it eventually once I'm done with real estate. But I had printed my resume and I really wanted to go work for Ultra Records, which was like the king of like dance music at the time. They owned every artist. I was like, all right, I'm gonna do this. So I printed my resume. I looked up their office. I went to their office.
Did you really?
Listen to this. I went to their office in the city, and the door is like, you have to buzz in. It was a really small building. I was like, shit, how am I gonna do this? So I start ringing all the, bunch of people
Someone
were
let me in.
like, who is this? Who is this? I was like, hey, I just wanted to drop off I finally found them. I was like, hey, I just want to drop off my resume. They're like, yeah, like send us an email or reply online. And I just remember that moment. And I was like, shit, can I really not get in this building right now? Is this done?
Yeah, also,
Did I
you're
just
like-
Where
miss
did
my-
it end? Did you get your resume to them?
I broke into the building
Yeah.
because somebody held the door open.
Right.
Yeah.
Took it, slid it underneath their door, and then got a rejection call a week later.
Oh, but
it was-
someone
at least
actually
they
did look
called
at
you.
it.
yeah, they
that's-
called me. I was too young. I had just started college at the time. They're like, thank
I don't
you.
feel like that's the
appreciate
type of place
hustle.
where a traditional resume does it.
Yeah, exactly.
Anyway, I didn't want to sidebar, but all right. So you start at Brookfield, and you're in a
Yeah, so I'll give
relatively
you,
junior role.
Yeah, so I'll give you so I'm working at this fund in Boston. Global financial crisis happens. Lehman Brothers, Bear Stearns, we all know. And the fund at the time had 3 development projects, ground up condo developments in Florida. And I'm riding the elevator up, and the CIO of the fund is in the elevator with me. And at the time, I assume he knew I worked there, but I don't think he really knew who I was. Probably the last guy hired, the most junior guy. He looks at me and goes, Ben, you're from Florida, right? And I'm like, yeah. And he's like, you should move to Florida and help us work out these projects. And so at 24, effectively went back home.
Wow.
And I spent a year in the depths of the financial crisis, being a custodian of the fund to
Oh.
Anglo-Irish Bank, Wells Fargo, et cetera, our construction lenders on these condos, which at the time I was sitting there going, oh, geez, like this is not the path that I had anticipated. Looking back, it's like invaluable learning.
Yeah, of
Right.
course.
But that's what started me on the path of, okay, I got to figure out my next move. And like most things happen, my girlfriend at the time was living in New York. And I was like, well, I should at least look at jobs in New York. I'll look at jobs in Boston. And I sent my resume into like a Select Leaders. Does Select Leaders still
Yeah, of
exist?
course.
So, all the Select Leaders job listing for an analyst at Brookfield Office Properties. I didn't know the business well, but I had worked in a Brookfield building in Boston. So I knew they were big landlords, an office REIT. Sent my resume and I got a call and I was like, oh my God, I'm going to go interview in New York. And the day that I had the Brookfield interview, I also had another interview with another company. I won't mention the name, but another company just outside of the city. And like, I'm not a New Yorker. So I'm like, okay, they're at World Financial Center and I can take the train up to this other thing and I'll be able to knock them both out and then fly back to Florida. And I get to Brookfield at like, let's say it's 9 a.m. I had a 2 p.m. afternoon interview. And like, these were the days, like I didn't have an iPhone, I didn't have a BlackBerry, like I had just a normal. So I'm sitting there going, okay, I should make it. I'll figure this out, get on this subway. And I'm sitting there and the first person I meet, it's like, okay, well, since you came up from Florida, like we'll just have you meet everyone.
They super date you?
This guy will take you to lunch and blah, blah, and I'm sitting there freaking out, being like, I'll never make this other
But it's also
interview.
great. You're
Great, but I also didn't know how to like actually get in contact with
Right.
the person and be like, I'm not going to be there at 2.
Oh, no.
Because I didn't have my emails on my phone. Like it was a whole
Right.
thing. Anyway, long story short, they did the right thing. Like I met everyone. It was great. And I left feeling pretty good, but I had reached out to the other company and said, sorry, I got stuck. Never heard back from them. Now I know the guys there really well. We're all good. But everything works out for a reason. So yeah, 15 years ago, got hired at Brookfield when our real estate business was a publicly listed office REIT. And that was primarily our business. We were large Canadian asset management, Canadian conglomerate with really the same pillars that we have today: real estate, private equity, renewable energy, and infrastructure. And our real estate business just happened to be at the time predominantly office, and it was owned on the balance sheet of this public company, which our parent company was the majority shareholder of. and worked in that investment team for a couple of years. We ended up privatizing that business, and then subsequently respun out Brookfield Property Partners, which was our last listed entity, which was a global diversified real estate business. And at the same time started really the majority of what our funds business is today. So 12 years ago or so, with the first fund of the series that I'll talk about a little bit later that we just closed our most recent vintage of. But over the last 15 years, the evolution of the business has just been tremendous in terms of breadth and scale and growth. And I've just been fortunate to be there riding the wave along all those different iterations. I spent 4 years in New York, then about 3.5 years in London as we were helping build our European business and do more deals both in the UK and on the continent. And then about 7 years ago, maybe 8 years ago now, came back to New York and have had a handful of roles across our business since. And now my primary day job, as you said, is I look after our business in the Americas, which is Brazil, US, and Canada. And then with one of my partners, sort of co-president, to support our CEO across our global real estate business.
Wow. Yeah, and were you guys there? Were you there during the general growth?
All the iterations.
Yeah.
So that's
we'll
you brought up the good one. So you had one of the most record years that anybody could have, and it was 2018. What was in the air? Like, what happened that year that set off the deals that we're going to talk about?
I think it was just a confluence of factors whereby you had a little bit of the cyclicality that we typically see in markets where there was growth across many businesses. Rates were low, as we know them today. We thought they'd be low forever, right? Hypothetically, but rates were low. And so you had real momentum around a lot of transaction volume, I think across all sectors really, and on a global basis. But what you also had, and it's what you're alluding to with some of the big transactions we did, was a real catalyst and a real logic for take privates and why public companies maybe that weren't trading appropriately at appropriate levels were more candidates for transactions, whether that be the debt financing availability, the cost of debt, the amount of equity there. So I think it wasn't unique in 2018 that we were busy. I think the markets were pretty robust. But it just happened to be a confluence of factors where, the market will read we did a transaction and it was X billions of dollars and it'll be like it just happened. But in many cases, nothing's linear in the way we do business and the way we make investments. So a lot of these businesses, we'd either been around them or we tried to buy them or we knew them for years and years and years.
Yeah.
And so these were things that we had studied and looked at for a long time. And it was kind of a confluence of events where you have to have a lot of stars to align to do large transactions, both on the buy and the sell side. And I think it was that was sort of that environment.
Got an investor portal? Great. But if you're still tracking payments outside the system, manually reconciling your waterfalls, or keeping your fingers crossed that your platform provider delivers your distributions on time, you're not getting what you need. InvestNext is purpose-built to handle today's capital raises, digital subscriptions, intuitive deal rooms, complex distributions, and direct ACH payments. While you focus on investors, InvestNext handles the back end with less friction and more firepower. Don't let outdated tools hold back your next raise. Upgrade your stack at investnext.com/nocap.
That's for sure. So let's talk about two of the biggest ones. And, I don't want to define your career by these, but these were really big milestones for you. First one is the Forest City Realty Trust deal. And the other one that we want to talk about is the General Growth Properties, GGP. And those happened within 4 months of each other.
Sure.
The Forest City deal was an $11.5 billion deal roughly. GGP was a $15 billion transaction. And to your point, these weren't linear. There's a lot of things that went in here.
Yeah.
But there is a general theme, and I think it's still true to the properties that Brookfield acquires today, what you guys have done over the last few years, maybe your role, and that's what you're acquiring has the dislocation buzzword amongst sponsorship and capital stack, not the assets.
Yeah.
Mm-hmm. So I'd love to hear, some of your insight on that. So
I gotta get a T-shirt that says that.
Yeah.
It's the capital structure's broken, not the assets of the businesses. Because I do think you hit the nail on the head. I think that's honestly, that's the way we think about investing across all of our businesses. Like, we have a DNA, whether you're buying, industrials business in our PE business, or you're buying, a port in our infrastructure. We have a DNA to want to and need to, frankly, just own really great assets and great businesses, because in the fullness of time, they're durable, they're resilient. Typically, if there's a lot of ways to add value, you typically get rewarded for that. Compounding, increases in valuation and cash flow is how we like to make our money, as opposed to market dynamics of yield compression, et cetera. So I think they're all examples of, we really want to find great assets, great management teams if we're buying a business.
Yep.
And I don't think it's unique to real estate. So I think it's how we think about investing at Brookfield generally. Look, both of those transactions.
Let's dig into them. Start with GGP, because that one came first. So
and that was big. I mean, for those that were in the business back then, I mean, that was all in the headlines.
Just to give the listeners a little bit of context prior, and then I don't want to steer you, because I want to hear what you have to say about this. But you guys bought the second largest mall owner in the country, behind Simon Properties. Simon, depending on how you're looking at it, is thriving today in a lot of aspects. You guys also bought, it wasn't just retail, it was malls. When retail was a dirty word, malls was like, people are throwing up when they hear it. So I need to see what was behind your eyes, how you guys saw the future of this deal playing into the portfolio.
Yeah. So if you step back, you really need to roll the clock back to 2009, 2010, the first iteration of our investment in GGP, which was effectively with our partners restructuring GGP and taking it out of bankruptcy. And that was, at a time where, forget retail being a four-letter word, like the world was on fire, right? But what you said was even true then, which was, it was a collection of some of the best retail assets in the world, super unique to be able to get at scale, at quality, and with a really good management team, and with a view that markets are cyclical, and with a recovery, we would be really right on a relatively large bet. And that was really the first iteration of GGP. I think what manifested itself in 18 was, again, we'd been around the business for a long time. We had seen the performance in terms of sales growth and rents, et cetera. And like retail was absolutely, this would have been definitely a contrarian view in terms of the opportunity set. We really knew the assets, and we really knew what was happening fundamentally. Did we know in 2018 that we'd see such a shock in rates? Did we know that we'd see COVID? We know we would ever have manifested that self in its underwriting, but we knew great, fundamentally good business, and what we thought was something that was undervalued and or mispriced.
And I imagine there probably weren't a lot of players who could take down a transaction of that size.
Yeah, I think that's right.
Was that balance sheet or?
Yeah, so we did it. Yeah, we did it with some partners and on Brookfield Corporation's balance sheet. So we still own that business within the corporation on our balance sheet, which frankly just gives us a tremendous amount of time and flexibility on how we structure that business, how we capitalize that business, and what the ultimate business plans are. Because if you think about what you have in that business, you have some unbelievable fortress malls. And then you have other malls that are maybe the second best mall in a market, where we've talked about this for a long time, and it takes a long time. There's densification opportunities. There's plenty of opportunities to add value or create value through alternative uses, through repositioning these malls. But if you think about the construct of retail, right? Commerce, it's people coming together, it's social fabric of some communities. These are very valuable sorts of assets. And so specifically because of where and how we own it, we can, over a really long period of time, continue to find ways to add value. And it was a big business that we knew. That was definitely a contrarian investment, but that we knew that we could continue to see compounding growth at top line, which is what we have seen the past couple of years. You guys will have known, like, retail is performing really, really well. No new malls are getting built.
That's right.
And I think we could all probably agree there are are too many malls that exist today, and we'll talk about office at some point. We'll probably have a similar arc. But if you own the best malls, just like if you own the best office building, there's still a very good runway to see returns out of that sort of real estate.
And just some of the guts of that transaction itself. So when you guys had closed on GGP, there was assets that you had sold off, or did you sell off the assets, or were you partnering with CBRE and Nuveen at the time? What did that capital structure look like? The stuff that you did keep in the portfolio, and I completely understand it's been some time, so I'm not holding you to this exactly, but very curious, like the assets you guys held on to, was it the densification and the ability to retype some of those, or was it the strong cash flows?
Probably. I mean, there's there's over 100 different assets. They probably fall into all of those buckets. Some that we want to own forever. We want to own forever. We want exposure to them. They're going to continue to, say, compound cash flow and value. There are some where they're ripe for densification, whether that's more of a multi-use or different types of retail or demalling the retail. And then others that, over time we will continue to recycle capital out of, monetize those, and take that capital and either reinvest it in that business or in other assets or other opportunities in our balance sheet.
So on that note, I'm just curious. So what's your strategy when it comes to deciding when to tap your balance sheet versus, I guess the fund LP route?
Yeah. So it's pretty distinct. If I just give you a little bit of a sense of our funds business, we have multiple strategies across multiple regions. But if I just generalized for you, we have a flagship fund across all 4 main businesses at Brookfield. So in real estate, it's our global opportunistic fund. That is a fund that, because of the scale of it and because it's global, really allows you to move that capital in any which direction where we see the best pockets of value. Okay. We have multiple of other strategies. We have a credit strategy. We have a secondary strategy. We have a U.S. open-ended core plus fund, which we then also replicate in Europe and in Asia. And in some instances, we have sector or regional specific funds. So we've got a lot of real estate strategies. Our biggest one is our global opportunistic strategy. Our balance sheet, so if I just pivoted for a second, our balance sheet is the biggest LP in all of those strategies. So our balance sheet is investing alongside every single one of our institutional partners in our strategies, and that's where it's getting a lot of its real estate exposure. Our balance sheet also has direct exposure to the legacy businesses, mainly on the office side. We privatized BPO. We still have many of those office assets on our balance sheet. GGP, as we mentioned, and it allows us to be very flexible, either to utilize that capital to get exposure to assets that we want, again, for a very long time, to continue to compound value and cash flows, and/or allows us to unlock opportunities within the funds, either from a fundraising perspective, from a fund capitalization perspective, and/or partnering alongside the funds as a co-investor. So it just gives us a lot of flexibility.
So you invest alongside your LP investors through the balance sheet.
The balance sheet is an LP in our funds.
Yeah, very put your money where your mouth is. Probably the most unique capital structure I think we've ever heard of. And I'm not sure that the broader market necessarily realizes that.
It's unique. I'd say it's not the norm.
It's very easy to look at Brookfield and say, are there landlords? Right? And then when you think landlord, you think operator, but you never think of the funds business. You're LPing alongside your funds. It's super interesting. So moving to the second deal that we spoke about is the Forest City Realty Trust deal. And, we had an alum of Forest City just on. Yeah. I'd love to hear about that. So the theme, at least from my perspective, was your penetration into urban cores. You guys got office assets, retail assets, some life science, I think. What was that lens? What were you guys looking to accomplish with Forest City? Yeah,
it's I always think of Forest City as maybe the best case study for how our business is different and how we can do things that maybe other people can't do. Because you could start with scale, but there's a couple of other groups that look like us that could do these transactions at scale. So it's a differentiator. It means the number of people that can do it are small, but it doesn't mean we're the only one that can do it. I think what really differentiates our business, and you just hit on a couple of these things when you said, I think of Brookfield as a landlord, as an operator, is exactly that, where we bought a lot of land we can develop, okay? We understand multi, we understand office. And not only do we just understand it from an investment standpoint, we can take these assets, we can take the people, we can bolt them into the platforms that we have and really, really understand the operational component. So we're, again, not just hoping that we buy things really cheap and that the markets go our way. We hope we do those. It's almost table stakes. Then we want to make sure we're actually best in class operating these things so we can add additional incremental value at the asset level, really have good insights when we're underwriting. What are rents? What's the competitive set? What does supply and demand dynamics look like? And that extra layer of information, I think, just gives us that competitive advantage because of the asymmetry there. So Forest City, in some ways, was the perfect deal for us because a lot of buyers that could price multi efficiently, price office efficiently, life sciences, but would look at the land and the development and go, it's some long-term, some of it was, single family housing, some of it was townhome product, mixed use, high rise, low density, the whole spectrum, and say, well, we can't do that. And then others would go, we're developers, we love the land, we didn't need all that operating stuff. And so when you can put it together and understand the whole piece, I think that's a differentiator. And I think that transaction just exemplified that in a nutshell, which was we can understand it all. We can see where we can create value in other places where we may not be the best owner. You know what? Let's hit the market and let's recycle capital out of those assets. We did that very successfully out of some of those portfolios. And we can invest on a long-term basis and create a lot of value along the way. And I think we've done that.
Your LPs expect more now. Instant access, integrated funding, seamless distributions, and polished experience every time they log in. If your portal hasn't kept up, you're already behind. InvestNext helps you deliver an investor experience that keeps you one step ahead of your investors' expectations and reinforces your brand at every step. Because staying ahead means raising the bar. Upgrade your investment management platform and elevate your investors' experience at investnext.com/nocap. Yeah, that's very interesting because when you look at like you said, developers, owners across the gamut, you have timeline constraints, from your investors, cost of capital. For you guys to take such a mixed bag and find homes for it is it's unique. I think of Brookfield and maybe like one or two other groups, if they're even interested in doing that, of who can actually do it.
Yeah. Agreed.
Right?
Agreed.
So between those deals, right, you're in 2018. I'm trying to get in Ben Brown's head. 2018, you do two monster deals, right, that arguably are steering Brookfield for the next 7 years to come, bringing us to today and who knows how much longer. What else got you excited? Was it opportunities for Brookfield's growth, or was it just really good deals and you guys were, into the markets and positive about the assets? What were your lessons learned from 2018?
Yeah, look, so I'll step back. So we have a tremendous amount of people, again, all across the globe that are seeing opportunities every single day within their own market or their own sector, frankly. And we have the benefit of having a lens of relative value. And so, like I said, we've got flexibility to go wherever we see some dislocation and wherever we see the ability to make the sort of right returns, taking moderate risk, taking the appropriate level of risk. And I think that's true, every year that we're deploying capital. So I'd say you're picking a year where there were two headline grabbing deals, but if you looked at subsequent years and years to come, aggregate deal volume is probably the same. The composition will look very different. And I think that's what I love about our business is when we can find opportunities to do things at scale, and there's a discount because they're at scale, they're great businesses, we can buy all the things that I had said previously, that's where we're going to run. When things at scale maybe are overpriced because, and we saw this, frankly, we saw this coming out of COVID. Rates were zero. You had a tremendous amount of capital flowing into the space, whether it was from the retail funds and just general fundraising. And we saw a lot of scale actually getting priced to perfection. We were, in some of our sectors, we were pivoting to buying individual assets, which is, for our business, not that efficient, not typically where we'd go, but we've got to have that flexibility. So I'll give you the example of that. So the last 12 months in the US and in Europe, we've probably, let's say we've done 3 large logistics transactions and probably $2.5 to $3 billion of gross value. Okay. If you looked in 21, 22, we probably did the same aggregate amount, and we had our teams buying onesies and twosies. And that was because the last year or so, we saw a lack of liquidity for large deals. And so we were buying things at values that we felt better about because there was less competition. We roll back to when there was a mountain of capital coming into the space wanting a certain sector. We had to have our guys work in little markets, and you can look at the macro, but we all know real estate's a hyper local game. And they were knocking out little deals here and there and made some great investments, but it's just a pivot to a strategy. And so that's what we really want to do when we step back and think about, okay, where are we going to spend our time and our effort and our capital? It's where we find those inefficiencies and those dislocations.
So right now there seems to be sort of a dislocation between the public space and the private space. You look at NAV values right now versus where private deals are trading at. Are you guys taking advantage of that? What are your thoughts on that right now?
I always want to say yes.
Yeah.
But look, no, I think.
And why?
Yeah.
I'll ask.
Who wouldn't say yes?
So, okay. So we'll talk a little bit about apartments, right?
Yeah. Let's do it. It's my favorite topic.
So if you think about it, I'll give you the same exact example I just gave you on logistics and what we were doing on apartments. Between 2022 and 23, I think we sold $10 billion of apartments. The last, again, call it 18 months, we've probably done $3 or $4 billion of acquisition, maybe $5 billion of acquisition of apartments.
Super few groups were selling that kind of volume of apartments.
Correct. Well, no, most were buying. Hence why we were selling.
Yeah.
And I think that was, okay, we see where rates are, we see where cap rates are, and we understand it. And we understand why there was exuberance around it. We get it. Rents were growing and supply was not growing at the pace demand was. But you also have to look at it and go, what are my go-forward returns? What's the capital that I've already made for my strategy, my LP, and
don't get greedy.
And also, where can I go recycle this capital? And if you can recycle it with hypothetically either better supply demand dynamics, higher returns, more contribution from cash flow as opposed to yield compression, maybe you do that. And so I think we picked our spot there and we took advantage of that window.
Yeah, you said you could hit what you need to hit, get out. And why hang on longer when you don't really need to?
But you made it very simple, and you had 2 points in there that couldn't be harder. It's the first one being, how are you going to recycle this capital? So you need a depth of opportunities if you can even explore the opportunity to sell these things. And the second thing was being able to spot the supply-demand imbalance and say, look at how many people are buying apartments. This is the star child of everyone's portfolio. We should go sell right now.
Yeah, I mean, listen, I'm a multifamily broker.
Right.
It's hard to take a step back and go, is this normal or not? And to be able to take a step back and look at the macros in 2022 and say, something's off.
I almost think it's that's what I kind of love about real estate. It feels like it's a simple, common sense business.
Yeah.
You just gave the nuance there, which is, you got to step back and peel yourself away and sometimes have a slightly altered lens. But if you really think about it, I think this is investing generally, is if there's exuberance and you have to believe a lot of things to go right, it's maybe not where you should be running directly to.
Right.
And typically where people are a little cautious, or when people are cautious, that may be where you want to investigate more. Now, that doesn't mean, you should run towards the burning house when everyone is, sitting in the sun, sunbathing in another sector. But you have to look at those in comparison to is this mispriced? Is this misjudged? Is that over exuberance warranted? And in many cases, it can be.
The news is important, but if you're a busy real estate professional like me, you don't have time to skim through dozens of dry and ad-filled media outlets each day. That's why I read the CRE Daily. It's a free email newsletter that cuts through the clutter and delivers concise, witty commentary on the latest trends and transactions in commercial real estate. If you're a commercial real estate professional, you owe it to yourself to try it out and stay on top of what's happening in the industry. It's only 5 minutes a day. Visit credaily.com to sign up for free.
This is a great transition to
for office. Yeah, I was thinking the exact same thing. You couldn't be more spot on.
Yeah.
All right. So I want to get us out of the year 2018, but you were on such a roll at the time. You guys did a deal that's actually near and dear to my heart because I worked in the building, and that was 666 Fifth Avenue, which is no longer 666 Fifth Avenue. Yeah. So rebranded.
Yeah, we
changed
right,
it's 660. All right. I'm not
sounds cooler.
I'm not going to call it 666 again, but that's partially what I loved about the building at the time was that address. So you guys acquired the leasehold at the time, and if I'm not mistaken, which I usually am, this was the largest office deal in terms of dollar volume paid for an asset at the time in New York City.
I don't know. Maybe.
Because I remember as a young analyst looking at it and going, whoa, like you guys paid $1.3 billion for the building at the time.
You'll fact check this, but I want to say, because we don't really track this, because we don't really need to give ourselves awards for doing the biggest deal, but I want to say that maybe when the Kushners bought it from Carlyle, that may have been the largest office trade.
Yes.
In my mind, I want to say
that's right.
Subsequent, when we acquired it, I actually think maybe we exited 245 Park at a higher gross value when we sold that. Or there was a couple of others, but I think you're right. I think at one point it definitely was.
The Kushners definitely did pay the highest price for an office building back in 2007 that was ever paid. But past the accolades, right? So you guys acquired the ground lease. And to your point before, two things interesting about this deal. One, it's a single asset. It allowed you to deploy over $1 billion, but it was a single asset. Yeah. And the other thing is, it definitely wasn't a straightforward acquisition. This one had been in the news for years at the time. When we were in the building, this was going on, and I was like, what's the future of this? There were renderings at a time that it was going to have this glass arch and then a park, and like every other week, the asset looked different in the media. So what do you recall about that deal? What was a good story? What's a bad story?
I don't think good or bad. I mean, it was, look, it just had all the characteristics of what we like. A world-class location, Main and Main, right? It had a lot of noise around it that, again, wasn't anything broken with the building. Mm-hmm. There were just things that created a lot of turbulence around the building. You'd mentioned some of them, but it was a little difficult for many people to touch and just got put into the basket of too tough to deal with. But when you step back and you say, even today with what I know now, if you said, what's the tightest office market in the country, you'd say the Plaza District, right? Yep. It wasn't so different then, pre-COVID. I mean, you knew Park Avenue corridor, Fifth Avenue, Madison, like there's a reason people want to be here. And if you believed in the long run, the centricity of demand in a place like New York, in a prime location, you'd be right in the fullness of time. That's kind of the bet we made. And the bet we made was, it was a circa 1957 vintage building, and you worked in the building, and everyone in the market has already told me the 13 issues that are wrong with the building since we bought it, the ceiling heights, the column grid, like we know this. But we saw something as an opportunity, which was, and we've been successful doing this, around the world, is if you can reimagine it, and yes, you can't change some of the physical constraints, but if you can accentuate others, you can really make something special. And that was what we viewed this as, the opportunity. I think we've done that. I think with the repositioning of that asset, we've given it a completely new life. We've been tremendously successful with the lease up, where we've just shook hands on the last lease. The building's 1.3 million square feet. It'll be 100% leased. Very good rents. And with all of the headwinds that we were dealt with, since buying an office building in New York since 2018, it's pretty well positioned today. Like it's really right in the heart of what occupiers want. I think what investors want in office, and it's been a really great, successful project that was really, really hard. Yeah. And I think those two things can be true, but those are...
Ben made it simple again.
Yeah, totally. Well, okay, so we talk a lot about office. I know you historically have been an office guy. Alex is an office guy. Can we talk about some other asset types? Where do you see the most legs right now? Where are those dislocations outside of office? I think office, we could cover office a little bit more, but I mean, let's talk about some other types of deals that interest you.
Yeah. So good. I'm going to give you a little bit of I'm going to do my best to give you a little bit of a global lens. Yeah. So we're talking about our whole business, but it's hard not to bring everything back to North America.
Well, we're New York.
Well, because the whole world revolves around.
Yeah, as you know. Okay. So in the effort of trying to make things simple, I'd say today, maybe just to generalize, I'd categorize sectors that are interesting to me that we like in two different ways. Mm-hmm. Sort of the momentum sectors where you have clearly very good demand drivers. Let's say supply is in check, should be resilient if there's a downturn, et cetera, that are not really that hard to identify, right? Things like housing, and not just apartments, but manufactured housing.
Mm-hmm. You're talking at the macro level.
Yeah, just the trend. I'm generalizing for you. So your sort of momentum sectors. Housing's got good growth prospects. Take the U.S., for example. Let's say rates stay a little higher for longer. I think we can all agree that they're probably not going back to where they were anytime soon. Home affordability is going to be out of reach. Right. Renter cohorts are getting bigger and bigger every day. That's a fact. Not that hard to identify, but that's a fact. Maybe before Liberation Day, everyone would have consensus logistics. Mm-hmm. We still view it as a very, very, very desirable sector when you think about the continued penetration of e-commerce, the continued changes in behaviors of consumption. Like I'll walk out of here, need something on Amazon, and my expectation is I'm getting it tomorrow.
Yeah. And that's no one's changing that.
That's not changing. Yeah. And frankly, so when we were talking when we started, I'm 40. Do I feel old? I feel old because I think about my 8-year-old is gonna only know that you order certain things on Amazon, and then you're going to go to retail for a different experience. Fine.
Do you remember hitting that moment in time when you were still taking up the greater part of your afternoon, going to go get groceries, and you thought to yourself, wait a second, why am I still doing this?
You know what sticks out to me in that time?
What's that?
It's like, I remember the feeling of when I probably heard what I'll say is like the last time someone going, it's the internet. Like stores aren't going away. E-commerce isn't going to get bigger. It was something to that extent. And remembering the feeling when I was like, "Oh, this person's wrong."
Yeah,
like this is.
What you guys should.
Let me just because what I actually think we're starting to realize, and maybe you guys will either agree or disagree. But we should have the debate. Is I think the penetration of e-commerce and the changing in our behaviors has done two things. One is it's made us as consumers just different.
Yeah.
We're different in every ways. Like our access to information, trends are now global. Like what someone's wearing in Tokyo. Mm-hmm. It didn't used to happen, right? Mm-hmm. But we're just different consumers. So let's take that as read. I actually think in some ways, a lot of this and where it'll shake out is the store is actually just as important as it was.
Yes.
The format, the experience, and what you get from going to the store is different.
Yeah.
That's fine. And then there's a bunch of nuance around the edges on what's really valuable long-term retail, what's,
Yeah.
But I do think, and retail would be one of those, where in many ways, retail's probably in the momentum bucket. And I think if you looked at institutional investor appetite for grocery anchored, essential retail, et cetera, it's resilient. People are still going to Supercuts in their karate dojo. That's not changing. The internet's not changing that.
Jack's been taking karate classes online.
Well, listen, this is coming from the jiu-jitsu master over here, so don't mess with him.
You got to have your. So I think that. So those are all interesting. So if you thought about that, sort of logistics, housing, maybe retail, pretty good demand drivers, good tailwinds in terms of the demand side, and supply is pretty much in check. We talk, apartments would be a little bit more nuanced. You go market by market, but on balance, if you looked on a historical basis and where rates are and where costs to build are, we feel pretty good about the medium to long term in terms of supply across those sectors. So those are good. We keep investing behind that.
Retail, apartments, feel good about.
Yep, and logistics and all. I'd say all forms of rental housing.
Mm-hmm.
But like those are not that unique. So I say that with, I say that with that as context, that I realize I'm probably saying the same answer 80% of the people would give you. The one other that I think has a tremendous amount of exuberance, also mileage, so I'm not denying it, is obviously data centers or digitization generally.
Right.
We'll come back to that because we have a couple of views on that. We're one of the largest data center investor and developers in the world. We've been doing it for 15 years, and so while it's new to a lot of people, and I think it's new to real estate, we know it, and we've been doing it for a really long time. And
it's such a unique class too, because it's not really just straight real estate by any means.
Is it in your infrastructure buckets, or is it
both? Yeah, both. Yeah, so most of our data center businesses sit within our infrastructure strategies, but a lot of our data center pipeline, now that you look at highest and best use of land and where we actually already own land that has a path to power, entitlement to power, et cetera, is actually starting to come from our real estate business. So we're actually finding many ways where
a lot of crossover.
Wow. Yeah, very much so. So again, going to the simplification, just generalizing. So those are interesting for some of the obvious reasons. So some of the sectors that I'd say are probably in the, let's say, more headwind category, where you have to be a little more cautious on maybe near-term demand drivers, maybe depletion of demand in aggregate over time, and maybe supply's in check, but maybe still oversupplied. You'd think about office would clearly be in that category. Life sciences would be in that category. Hotels, not for those reasons, but hotels just for the fact that whenever you have, and again, hotels are probably different in the US today than maybe I'd give you our views on in Europe or in Asia, because different demand drivers and different health of consumer, let's say.
Can you give us an example of that?
Yeah. So I'll give you a couple examples. So I would say we're actually buying hotels everywhere. So I say this with, but different catalysts to why in the investment thesis. Say from a North American perspective, you've seen a pullback in the leisure, you've seen a pullback in the transient. If you said potential long tail risk is slow down the U.S. economy, maybe inflation sort of cuts back, maybe rates stay higher, but average U.S. Consumer pulls back a bit, probably a little bit of risk to hotel demand. I think we're starting to see that through the industry. But hotels, because you reset your rents every day, are just naturally operationally levered and financially levered. And so you just see a little more distress or catalyst to transactions happening quicker. That we like. Like if you can go buy, again, a really great hotel in a really great location, hard to come by, hard to replicate. And if you have a know-how on how to reposition hospitality assets, you can get really rewarded. So we did give an example that we just exited earlier this year, PGA National, which is in Palm Beach Gardens.
Yeah.
We bought that hotel, did a massive renovation.
By the way, I was just there not too long ago.
What'd you think?
Looked great for the age of the property.
Yeah, exactly. Yeah. It's not a newer resort. We gave it a full uplift, full facelift, I should say.
There's a cool like sushi speakeasy type vibe.
We did the F&B. So if you can do that, and again, reinvigorate new life, and just like I said, about 660, and then you can create something new out of something that's old, fantastic. And there's a lot of investor demand for that. So we've done things like that. But that is buying a really unique piece of property with potential to create a real brand around it, et cetera. Two examples of where we've done this and where we're putting dollars behind this strategy. So in India, actually, a distressed situation in COVID, we bought a Indian hospitality business called the Leela Palaces. These are actual palaces. They are unbelievable pieces of real estate in the biggest cities or leisure markets in India, 1 billion people, large consumer base. And we, over the last handful of years, have repositioned that business, have really put a lot of effort and time rebuilding up that brand.
How cool is that? So you maintain
And-
the character of these palaces and just make it ultra luxurious.
Yeah. And we just listed that business domestically, did an IPO of that business. It's been tremendously successful. That'll be probably a 6x for the fund on that investment. But that's because you can create something really unique when you have really unique real estate. So similarly, what we're doing, and we just announced an acquisition of a really interesting hostel business in Europe called Generator. 15 assets, a little under 3,000 rooms. And if you know the European market, hostels are it's a real category. It's culturally, that's what young people do. It's how they travel. This business, we had looked at this business a handful of years ago.
Hostels are the coolest, by the way. I remember backpacking and I was in a
Tell us your
room
hostel
with,
stories.
everyone's got one. But it's funny, right? Because it is a very normal thing in Europe. And I remember being in a room with 10 bunks and it was all 21-year-olds.
Sure.
And then there was one couple in their 60s. And I'll never forget thinking
and to
is
them,
that
they're like,
cool?
yeah, it's
Or-
good, it's good.
Yeah.
Anyway, sorry.
So, but that's an example of culturally, it's totally accepted. But like anything, your consumer wants an experience. They want a brand they know, trust, safe, etc. So we're buying this business, which we looked at this business a handful of years ago. They expanded into the U.S. Culturally, the U.S. isn't a hostile market. That created some challenges for the business. And
What
so-
markets are big for hostels in the U.S.? Where do you see that?
No, I think they're not. I think
they're
the
not.
hostel
Yeah.
is not.
Got it.
Is not really a.
Yeah,
your
I don't think so.
traditional, even young U.S. traveler is not traditionally a hostel customer.
Yeah.
And so that created a little bit of headwinds for the company from a capital structure perspective.
it.
We were able to buy the European business, so we just closed on that transaction. We'll be able to, again, selectively go into double penetrate certain European markets we're in and/or new markets, take that brand, which is well respected, continue to acquire assets, increase the property count, likely, double or triple the room count, grow that business, and then eventually sell that business to someone that really wants exposure to that customer segment at scale where a lot of the hard work's done. So that's an example of a hospitality business that we
Very
really
cool.
like. but
Very
it's unique.
operationally intense. Huh?
You know what's really impressive about Brookfield and what you guys do? It's hard to call you a real estate company because even when you look at the mega funds of the world, right? They're in the fund business. So yes, they have divisions that are very good real estate operators. Blackstone owns a ton. Carlyle's great at multi, right? But you guys are so tactile with arbitraging public to private. There hasn't been a sentence that you've dropped on us that a company wasn't being taken private or you weren't taking somebody public. And you just don't see that with real estate companies, LPs, operators. It doesn't matter who you are. It's a fun game and some people are really, really good at funds. Clearly you guys are as well. But what is it about this tactical capital markets element? Everything you tell me, you guys are great, and obviously I understand your investment perspective, taking these headwind troubled assets, mostly headline risk, I should say, not headwinds, but you take the troubled assets that have good thematics and you make something out of them, but then you really do factor in this whole capital markets arbitrage on top of it. How does that play in day to day? How do you guys balance that between, I could barely keep my head on being a good real estate operator?
Yeah, it's look, we've got really, really good people that we give a lot of autonomy, responsibility, and accountability to. And like I said, we view ourselves as investors and operators, right? And so we've got people within our teams that wake up every day and they're thinking about logistics. They wake up every day, they're thinking about retail. And we got guys that wake up every day, they're thinking about capital markets. And we create a structure, but also a culture where they're constantly talking. So our head of capital markets is thinking about something. He may have just seen a hotel SASB and said, you know what? We were just thinking about this for X asset. Let me call the asset manager. Let's talk through the strategy here. When will occupancy ramp? Where we should be in the market? Can we take advantage of that? Then the second derivative of this is in our credit business, we can look at all of the things we're doing across our equity investing business and in capital markets and pick the spots where we see, again, the best relative value and say, you know what, we were going to bid for that and it went maybe 10% more than we thought made some sense, but we really like the asset. Maybe we should finance that. And we actually think we're going to get paid a little bit more on the financing because it's in this market or this sector, but we underwrote it. Our teams know it. They know the tenant profile. They know the rollover. We can understand all of that. So again, it's not a lot of people have information. It's not just having the information. What do you do with it?
Right.
And I think it's just what we do is we share it and we communicate. We're transparent.
Yeah.
And that leads us to, we got a lot of really innovative people that pick their hands up and go, oh, you know what? I just heard about this. We should go look into that. And
A lot of
creates
people
opportunity.
on the ground and a lot of data.
Yeah.
Yeah.
It's important.
I'm curious to get your thoughts. There's a whole different kind of pivot, and I know we're kind of running short on time, but you know, I sell apartments in Texas. The Sun Belt sort of narrative, right?
Yeah.
It's gotten so hot. Are you guys on that? Or are you against that? Where do you see sort of the opportunities now, whether it's the Sun Belt or avoiding the Sun Belt?
Yeah, no, I don't think, look, the way we operate, unless it's very idiosyncratic, like I don't think we have a broad brush on like markets and say, we're not buying apartments in Florida.
Yeah.
We may think about what are population and demographic trends telling us, and how does that interplay with supply, and then how should we think about where we could push rent growth. I would tell you it's more nuanced than that. And you know our apartment team, right? And so these guys, they're not thinking about Texas. They're thinking about not only a micro market, they're not even thinking about Austin, they're thinking about what segment or category in Austin should we get exposure to? Should we be buying affordable here?
Right.
Should we be buying like workforce housing? Should we be buying luxury? Where's the supply? Where's the demand? And where's the pressure on rent growth? So I would say,
You can't generalize.
We just don't generalize. We can't. And that's, I think it's helpful. Sometimes it's hard to, sift through all of that information and pick our spots, but that's really why we have the sort of team and structure that we have.
Let's end it on this note. I asked you in the beginning of this if you were an athlete before Jack made fun of me. I hope you spilled that.
Go on.
What I was going to say is you've been quoted before, you're very keen on teamwork, right? So and clearly that's the dynamic because you have so many people. Brookfield's a massive organization. You have a ton of people talking to each other, and clearly they're doing it really effectively because you guys are good at what you do. So from your eyes, what is the most important thing to foster that kind of teamwork or communication? Like, what do you come to work every day thinking about how you're going to bring that approach, to your team, to the other teams?
Look, I think it's simple. Like, everyone wins and everyone loses together. Like, we don't operate an organization where there is singularity, both acknowledgement and or blame. It's just not the way it works. If we get something wrong, I've got it wrong, just like 10 of my people have got it wrong. And it's one organization, it's one team, and that's when things go right or they go slightly incorrect, because not bad. We try to avoid bad. But I think it's creating that culture where it's collective, but it's also accountability, right? It's like, if we're in a room, I'm not going to be the one to have the answers, right? I'm not the expert. We get a lot of expert and a lot of people that will forget more about their specific craft than I will know. My job, in most cases, is to sit somewhere and ask just a critical question, just be a little curious, just to take the things that we're seeing across our business and probe. Have we thought about that? We just did this and that occurred to us, or a lesson learned here, but not to say, I don't like Texas multifamily, because I'm not waking up every day and thinking about Texas multifamily. We've got a whole team that's doing that. And I think by doing that, you push a lot of the responsibility, accountability, but frankly, decision-making down to your teams. And that's how we all win or lose together. And I think that's just in our DNA. I just think that's how we operate across all of our businesses. And I think it's important. It's different. It's the way we do it. Doesn't mean it's the only way, but it's how we can run a business at scale that's complicated, that's multifaceted, but has some connective tissue where we think about capital the same way. Like you mentioned earlier, us being the biggest LP in our funds, you don't get better alignment than that. It's so much further than that because we think about all of our clients' money as our own invested capital. But having that culture, it builds that, and it's just natural.
That's great.
Love it. That's a great way to end it. Yeah, thanks so much for coming on, Ben.
It's great to have
we
you.
could have spoken for another 2 hours just about data centers. So we'll have you on
we
again.
keep saying that we're going to have these follow-ups. So for our listeners, I think you can expect next season to see a couple of repeat faces.
Email Ben to come back.
Do not email Ben.
with thousands of emails.
Do not email Ben.
All right, thanks, Ben. Thanks.
Thank you, guys.